No matter how far away it seems, it's never too early to start planning for tax season. Before you know it, tax season will be back, and by then it will be too late to take many of the actions that can reduce your tax bill and keep more of your money in your pocket. So instead of procrastinating during the tax season, take action. Now is an excellent time to consider these 8 steps that will make the next time you file your taxes less painful. Hey guys, welcome to another exciting video by Finance Aligned. In today's video, we'll go through some steps on how to reduce your tax bill. But before we continue, kindly like this video, subscribe to the channel, and hit the bell icon to stay notified of more exciting videos just like this one. With that done, let's get right into the video. Adjusting your withholding. Your first step should be to ensure that enough money is withheld from your paychecks to avoid a large tax bill and underpayment penalties during the next tax season. Fill out a new Form W-4, Employees Withholding Certificate, if you've owed a lot of money on your last tax return. Complete the form using the IRS Tax Withholding Estimator, then submit it to your employer's payroll department. Your employer will use the new W-4 to adjust the amount of taxes withheld from your paycheck for the remainder of the calendar year. For self-employed, individuals are required to make their own estimated tax payments all year long. Calculate your estimated quarterly payment amount with the aid of a tax advisor or the worksheets provided with IRS Form 1040-ES, Estimated Tax for Individuals. Number 2. Start a retirement account contribution. Spending money on items that qualify for tax deductions is a common tax-saving strategy. One of the few ways to lower your tax bill while keeping your money in your own pocket, or at least in a retirement account in your name, is to make contributions to tax-deferred retirement accounts. You can contribute up to $20,500 to an employer-sponsored 401k plan for the 2022 tax year, or $27,000 if you're 50 or older. Do you work for a company that does not offer a 401k plan? A traditional IRA allows you to contribute up to $6,000 or $7,000 if you're 50 or older. On your federal income tax return, you can write off contributions to a traditional IRA or 401k. Also, the funds can increase tax-free until retirement. Start a health savings account contribution. You can start contributing to a health savings account if you have a high-deductible healthcare plan. You can put money aside in this tax-advantaged savings account to cover eligible medical costs. HSAs provide triple tax benefits. The first benefit is that HSA contributions reduce your taxable income. Secondly, any investment returns in the account are not subject to taxation. Lastly, withdrawals from the account are tax-free as long as you use the funds to cover eligible medical costs. Find out if your employer offers a flexible spending account if you don't have a high-deductible health plan. You can use pre-tax money from a healthcare FSA to cover a lot of your out-of-pocket medical, dental, and vision expenses. Make a charitable contribution. You may be able to deduct your charitable contributions from your taxes. Cash and non-cash donations to charity organizations are deductible as long as you categorize your deductions. Let's say on your 2022 tax return, your deduction is capped at 50% of your adjusted gross income, AGI, which is your gross income minus a few deductions and other adjustments. The catch is that in order to deduct charitable contributions, you must itemize, and around 90% of taxpayers choose to take the standard deduction rather than itemizing because it offers a greater tax benefit. Bundling your donations into 1 year is one strategy for getting through that hurdle. For instance, you may donate $5,000 this year to your favorite charity instead of $1,000 per year for the next 5 years. Bundled donations, when combined with deductions for home mortgage interest, state and local taxes, and out-of-pocket medical expenses, may help you exceed your available standard deduction. Take responsibility for having a child. The cost of raising a child is high. The good news is that there are 2 tax credits available to parents of dependent children that can help reduce some of those expenses. Child tax credits. By the end of 2022, the child tax credit could be valued at up to $2,000 per dependent kid under the age of 17. For high-income taxpayers, this credit is phased out depending on Modified Adjusted Gross Income, MAGI. That is, adjusted gross income with some adjustments added back. You can't claim the credit if you're a single filer with more than $200,000 MAGI or a joint filer with more than $400,000 MAGI. The child tax credit is partially refundable, so if it reduces your tax liability to zero, you can receive a refund of up to $1,400. Child and Dependent Care Credit. When you work or look for a job, the Child and Dependent Care Credit can assist with the cost of caring for a dependent child under the age of 13 or a wife or dependents who cannot care for themselves. The amount of the credit is determined by your adjusted gross income, the number of dependents in your care, and the number you spent on care throughout the year. The credit is not available to taxpayers with an adjusted gross income of more than $438,000. Get credit for college costs. Paying for your own, your spouse's, or a dependent's higher education? If so, there are 2 credits provided by the tax code to help with the cost offset. American Opportunity Tax Credit. For the first 4 years of college, each student is eligible for a maximum $2,500 American Opportunity Tax Credit. The student must be enrolled for at least half-time and pursuing a degree or other educational credential in order to be eligible. The credit is partially refundable, so if using it reduces your debt to zero, you may be eligible for a $1,000 return. Lifetime Opportunity Tax Credit. The Lifetime Learning Credit has a maximum value of $2,000 for each return. Even if you aren't pursuing a degree, you can still use it for undergraduate, graduate, and professional courses. It isn't refundable. For taxpayers with high incomes, both the Lifetime Learning Credit and the American Opportunity Tax Credit phase out. Your modified adjusted gross income must be $80,000 or less in order to claim the full credit on your 2022 tax return. Avoid capital gains tax. When you sell an item, such as investment securities or real estate, for more than you paid for it, you must pay capital gains tax. For example, if you buy a stock for $1,000 and sell it for $2,000, you must pay capital gains tax on the $1,000 gain. The amount of tax you'll pay on such gains is based on your overall taxable income and the period of time you kept the assets. Short-term capital gains are those that are taxed on regular income tax rates, which can range from 10 to 37% when you've owned an asset for less than a year. Long-term capital gains are taxed at lower long-term capital gains rates if you've held them for longer than a year. There are a number of strategies for reducing or even avoiding capital gains taxes. Keep your investments for the long term. You can benefit from reduced capital gains rates by holding on to assets for longer than a year before selling them. Include dividends that have been reinvested. The cost basis, or original worth for tax purposes, of an investment should be taken into account when selling it. This includes any reinvested dividends. Say, for instance, that you pay $1,000 for a stock, invest $100 in dividends, and then sell it for $2,000 later. You pay taxes on capital gains of $900 as opposed to $1,000 if you factor in reinvested dividends in your basis. Consider donating valuable stock. Instead of sending cash to your favorite charity, consider donating stock that has gained in value over the last year. When you donate shares, you avoid paying capital gains taxes. Also, you can conduct the stock's fair market value as a charitable contribution. And lastly, take full advantage of state tax breaks. Along with state-specific tax benefits, many states offer their own versions of well-known federal tax deductions and credits. So don't forget to look for opportunities to lower your tax liability there. For instance, individuals who claim the federal child tax credit are eligible for New York's Empire State Child's Credit. California offers a tax credit for child and dependent care costs that is equal to a portion of the federal benefit. For residents who donate to charitable organizations, Arizona offers 2 different tax benefits. To ensure you don't lose out on any tax savings that may be available to you, check with your tax advisor, the state's taxation authorities, and any local ones. Tax credits and deductions may differ by jurisdiction. The basic lesson is that you should think about filling up enough to optimize your bracket if you are retired or close to retirement and your income is declining. That's it for today. What do you think about this video? Kindly let me know what you think about this video in the comments section below. Don't forget to like and subscribe to this video. Also, hit the bell to receive more updates. See you next time. Thanks for watching.